For this very first video about the tool, we're going to start with a very simple scenario. We've got a South African ultimate parent called Acme Auto, and it holds 100% of the shares of a Dutch company called World Teas Limited. Let us see how we do a qualifying globe information return for this setup, where both companies qualify for the transitional CbCR safe harbor, not being an substance-based income test, but de minimis or effective tax rate test. So we are going to start on the CE fact sheet because we need to fill in the company names, their tax numbers, the groups that they belong to, etc., etc. And if you look at the top left, you will see here instructions. They are on every sheet and they tell you what to do. I like to number my rows, so I always can go to the original order, which helps if you later want to compare files to each other so you have the right order. And then we've got this thing called CEID, and CEID just is the unique identifier that you use in your group for your company. For many, it'll be the unique identifier in the accounting system. For instance, South Africa could have been ZA001 and Holland could have been NL001 or something like that. And we will use that as a handle through all the other sheets in this workbook to identify entities when we deal with them. So this is constituent entities. Next, you fill in the real name of the entity, so the name as it is in the articles of association of the company, or as it is published in the company's house. If you have some entities that you must include for whatever reason, but they should not be in the GIR, you can exclude them here. You fill in the country code in here, and it will then automatically look up the country name up here. So light blue blocks generally, or columns, are automated columns. Look at the formulas and make sure that the outcome is correct, because different companies, different setups. If the company is incorporated in another country than where it is resident, you need to fill that in here. You know that from the CbCR already. And then you need to fill in the TIN number, and you need to make sure that it is the correct TIN number. There is in the tool a link to the OECD website where they tell you which TIN numbers of which countries should look like. You need to fill in the type of TIN that it is. You had to do that for the CbCR already, I believe. And then you can see there's a whole block of columns that we skip from a Q to a F, because those are related to CbCR, and we're not doing the CbCR, but you can use this tool for CbCR if you wish to. And then you have the same source of data for both files. What you must fill in is column AF to say whether the UPE, which entity is the UPE, and whether it's an excluded UPE, so it's basically an excluded entity, or whether it is another type of UPE, so you fill that in here. And I've added for you, where it made sense in the tool, the references to the PDF version of what the globe return looks like. So you will see copies like these, and you can see where these names come from. And it helps you, if you're not quite sure what these texts in column and in row 11 mean, to go to the OECD PDF guidance, and then you look under 1311 what they mean by UPE jurisdiction, for example. Next, we need to fill in the different CbCR, the different Pillar 2 rules which apply to the different jurisdictions. So remember, Acme was in South Africa. It has a QIIR. It has a QDMTT, so we will fill in GIR 201 and 204. Holland exactly the same. You need to talk about the globe status. For most, these are just constituent entities. If you've got something weird like a flow-through or a permanent establishment, or a MOPE, a minority-owned parent entity, or something like that, you need to indicate that here. And then we come to the ownership structure of the group. So this comes into the general section, corporate structure of the XML return. And you start by filling in the owner TIN. And what it then does is it looks up for you in if we just go to cell M14 here, you can see it looks up the owner TIN name and TIN number, and it fills that in automatically for you. You also need to talk about what type of ownership it is. If the company is held by the UPE directly, it's 801. If it's held by any other group entity, it is 802, or if it's a JV, 803, etc. And you need to fill in how much percent you hold. And if you've got 2 or 3 shareholders, you need to add that accordingly as well. You can see here in column AP, we go to owner TIN 2. If we filled out the structure, you can see you have again the owner name, the ownership type, the ownership percentage. If you've got more than 2 shareholders in the group, add automatically the same column with P3, P4, whatever you need. And if you've got a third-party shareholder, then Rule 70025 of the OECD guidelines on the GIR return says you must use no TIN for the TIN number because this is not a constituent entity. And then in a name, you can put non-group members, and the ownership type then is GIR 608. 806, which is then the what you see here in column AR. And then we go to the safe harbors. Now the safe harbors will come from the safe harbor sheet, which you will find right next to the CE fact sheet. And we will fill in the numbers there, and it will automatically then give you the XLOOKUP on which safe harbors are you in and which are you not in. When you are in a safe harbor, you must make a subgroup, whether you have joint ventures or MOPIs or not just normal companies in that particular jurisdiction or not. And you can see here, if you are in transitional CbCR safe harbor with just constituent entities, then you must fill in GIR 1607. If you have a joint venture, you must fill in 1608, etc., etc. You must give the TIN number of the subgroup leader. I always just take the UPE if there's nothing funny like joint ventures or anything like that in between. And it will then populate the name, and it will give you a subgroup title like this. And the subgroup title is the countrywide or the subgroup-wide equivalent of the CEID that we see here on the left side. So CEID applies for entities, and then TUT subgroups applies for countries typically, but if there are different subgroups in a country, then it applies per subgroup. The last 2 columns that most groups will have to fill in is which countries have taxing rights. So you do take the taxing jurisdictions, and it's only the countries which have implemented a qualifying IIR or a qualifying domestic minimum top-up tax, so a QDMTT, which have taxing rights. For instance, in 24, if you are in Singapore, you do not fill in Singapore as a taxing jurisdiction because Singapore did not have a QIIR or a QDMTT in 2024. And then finally, we tick the box saying that we want to make use of the simplified transitional rule, which allows us to fill in the data for the Pillar 2 return on a country level only, and we don't have to do it for constituent entities except where some exceptions apply, such as you've got shipping income, or you're paying out a dividend, or you've got a flow-through entity or something like that. And now we go to the safe harbor sheet, and we fill in the numbers so we can see whether we are in a transitional CbCR safe harbor or not. Again, at the top left, you will find instructions on what to do. It also gives you some formulas, as you can see here in the highlight, because you can choose whether you want to just fill in the numbers on a per country basis, or whether you want to do the constituent entities under the CE numbers sheet, which then feeds in to the other sheets, or you do the CE number safe harbor sheet. But for now, it is easiest to just do it in the country like you've done the CbCR. As a matter of fact, you can just pull these numbers from the CbCR and then add on what is needed additionally. So you can see here again at the top, I folded some columns just to make the tool more manageable. And then let's fill in what we need for the CbCR, for the GIR. So we need the total revenue. We need the profit or loss, right? Because we want to know the profit before tax. We need the tax accrued, and we need the assets for the CbCR. And that is all that we need. On top of that, we need to fill in the current tax, which normally will be the same as your accrued tax in your CbCR, but it doesn't have to be. So if there is a difference, then this must always match your current tax as it was in your published annual report of the different companies in that jurisdiction. You must fill in the deferred taxes, which is different from a CbCR because it doesn't have deferred tax. You must take out the uncertain tax provisions, and that will give you your simplified cover tax or income tax, as I call it here, and you divide the income taxes by the profit or loss here to get your CbCR ETR. You can see already here we are way above 15%, so we are in the CbCR safe harbors. If we move the slide a little bit to the right, you can see we have the CbCR safe harbor flagged here. Let's go one more. We can see that we qualify for Holland for the CbCR de minimis test because we have less than 1 million euros in profits and less than 10 million euros in revenue. And then we can fill in the data that we need for the substance-based income exclusion to see if we can make that one too. I've added a separate column for the assets SBIE. If we look at the very top here, you will see we are taking the, let me just make sure that we see the whole screen. Sorry. There we go. We are taking the numbers from the assets CbCR, but the assets in the CbCR do not need to be the same as in the SBIE because of different treatments of lease assets, because the CbCR may be based on year-end values, whereas the substance-based income exclusion rules require you to use the average values. So I've added a separate column here so you can change that if need be. We also need to put in your wages, that your payroll that you got during the year in the different jurisdictions, and then we can multiply that with 7.8% and 9.8% respectively to get our substance-based income exclusion total. And if these totals are bigger than our profit before tax, so 1.8 billion and 400,000, then we also are in a substance-based income exclusion safe harbor. But as you can see here, our profit or loss is bigger than the 1.8 million and the 400,000. So we do not make the SBIE. Doesn't matter, we make the others already. And then finally, if we were not in any safe harbor, we would do a rough calculation of our top-up tax here. But if we are in these columns, it means we need to go to the jurisdictional to the juris numbers as well to fill in the rest of our file. Next, we have to go to the summary sheet, because this is again a sheet that all the countries get, and you see here it looks up the subgroups because this is something that you fill in per country. And remember, when we did our CE facts table, we actually got the touch subgroups. So those touch subgroups that we got here are the same ones that we fill in here on the safe harbor sheet. You simply copy these and you paste them as values in here, and what we do on the summary sheet where we fill them in, it will then look up the jurisdiction where we are. We need to fill in which jurisdictions have should receive this. There is actually, you can see it goes to the filing sheet. We will look at that in a moment. If there are subgroups like joint ventures, they need to have their TIN numbers in here, and they need to be identified here. We don't need that because we don't have a JV. We fill in the countries with taxing rights. This is, if you look at the formula here at the top, automatically looked up for you. You just need to verify that it's correct because it is the same data as you have filled in on the CE facts file when you said here, these are the countries with taxing rights. And then we have the safe harbors. These again are pulled from our safe harbor sheet. You can see the formula here looks at safe harbor sheet, right? And I've done two columns because when you are both in a substance-based income exclusion safe harbor and another one, the SPIE asks you to also put in extra data. And there was an original version of the OECD documentation, a request to then also add in a whole lot of other data, such as your globe income and your adjusted cover taxes, all things that you should not be required to fill in if you are in a substance-based income exclusion safe harbor. The OECD changed that later, saying you can just put in 0 in those numbers because the XML schema require you to fill in those things. The moment you fill in your substance-based income exclusion, you must fill in those things. The easier workaround for that is simply to leave the substance-based income exclusion safe harbor out if you are in another safe harbor already. So when you do the Pillar 2 return, we actually look at this column where the column on column H may say 205, and we simply put in 204 only because we don't need 205. And then we are done for now with the summary sheet. And the final sheet where we need to go to is the CE filing sheet. We're going to make this bigger so you can see what's going on. And the only table that you need to worry about is this one. Again, you've got your instructions in the top. And here you've got your table that you need to fill in. What you see here in the bottom is a special added data required for South Africa and for Germany. If you're not in South Africa or Germany, don't worry about those. You copy the CE ID from the CE facts, this one here, into the CE filing sheet. And it will pick up the name and the TIN number and everything else for you. You need to determine which currency the return is filed in. That will be the same currency as what you used in the safe harbor. It will look up the currency name for you. If you, for instance, are in dollars, then you would put in how many dollars do you need to make 1 million euros in currency. So let's say it's $1.1 million. And the reason why we need that is because we've got this 1 million and 10 million euro thresholds for the de minimis safe harbor, for instance. You put in the start date and the end date of your financial year, and it will pick up the reporting period for you from the end date. The language in which you filed the return, the name of your group, the contact person. If this is new data, you always put in OECD 1. And then we come to the countries that are receiving the file from you and are sending it out. Now you always put in as transmitting country and receiving country for Pillar 2, you put in the country where you're filing. If it's Holland, you'll do NL. If it's Denmark, it's DK. If it's South Africa, it's South Africa, ZA. There are some additional data required for CbCR. We are not doing the CbCR now, but we are doing the GIR, and we need to fill in a few more columns. We need to choose the message type that we are filing. And again, if it's new information, you do GIR 101. I don't know why they need the doc type indicator as new data and the GIR 101, but it is the way it is. You fill that in. The role is you depend who files the return. Is it a UPE? Then it's 401. If it's a designated filing entity, it is 402. If it's a local filing and a designated local filing entity, it is 403, etc., etc. You fill in the consolidated financial system of the UPE. If it is an acceptable one, then you do 501, and if it is an Article 10(1)(b)(1), you do 502, etc., etc. You say what your financial accounting system is. Is it IFRS? Is it US GAAP? Is it German GAAP? Whatever it is. And then you say which countries will generally receive this return. Not which countries will tax it, but which countries are entitled to receive the return. And there are two things here. The first one is it's only countries that have a QDMTT or a QIIR or QUTPR from 2025 which are entitled to receive it. And I say in the list and columns, look at columns C, V, and further for which countries have what. So we have this table called lists. It is very, very tiny. Let's make it a lot bigger. And it has all the reference columns. So it has the language barriers, abbreviations for CbCR and the country codes, and it has all the different, you see here the OECD 1 and OECD 2 and all that data. And on the very far right, you also have lookup tables where it shows you which countries have which regime. So Albania is GIR 205 because it's got nothing. Australia is 201 and 204 because it's got a QIIR and a QDMTT. And I also have pulled a little more data like that for you from the OECD website itself on QIIRs and QDMTTs with the different links in the top where you can find these tables, where I'm sure they'll publish updates. And remember, we talked about the TIN numbers need to be the correct TIN numbers. And you can see here with a link again how the TIN numbers should be looking according to the OECD. The big takeaway from this table is you do not put CA in front of the Canadian TIN numbers. You do not put DK in front of the Danish TIN numbers. There are a few countries which start with letters, but most of them actually do not. And some countries, not all, do check whether your TIN numbers are in the correct format. You always want to have them in the correct format because the last thing that you want happening to you is you file your GIR with a lot of blood, sweat, and tears only to have a receiving country tell the country where you file, hey, we don't like this because the TIN numbers are wrong. Ask the taxpayer to file a new return. And that is it. If you've gotten this far, you have just completed your whole first pillar to return for every country that is in a CbCR transitional safe harbor. Congratulations. Send me this file. I will turn it into an XML file to you. I will send it back to you and I will join you on a call and we will upload your XML file. Bye for now.